Hey everyone, welcome back to the next vault. Today we're looking at Corning Inc., GLW, the longtime leader in specialty glass and ceramics. With rising interest rates, supply chain issues, and evolving tech demands, Corning is facing headwinds, but maybe also opportunity. Let's unpack what's happening with their business, recent performance, and whether this is a buy, hold, or watch situation for 2025. What Corning does and where it stands. Corning is best known for its Gorilla Glass used in phones and other devices, as well as optical fiber, display glass, environmental technologies, like filters, and advanced materials. Their presence spans consumer electronics, telecom infrastructure, clean tech, air pollution control, automotive displays, and emerging AR/VR OLED frontiers. Recent financial and stock snapshot as of now, Corning trades at around $77 per share. Its stock has experienced volatility linked to macro concerns, global demand for displays, smartphone refresh cycles, and telecom build-outs, especially 5G fiber-to-home. Key financial metrics. Revenue growth has been moderate. Margins are under pressure given raw material costs, energy expenses, and shipping logistics constraints. They also invest heavily in R&D to stay ahead in glass performance, optical fiber density, and emerging display tech. Drivers of growth and catalysts. Display tech. OLED, micro-LED, and foldables need high-grade glass substrates. Corning is well placed here. Optical fiber, telecom infrastructure. As 5G expands and fiber to the home, rural broadband is pushed, demand for fiber optics and related glass components is rising. AR/VR and emerging devices. Devices needing durable, scratch-resistant, high optical clarity glass will lean on companies like Corning. Environmental, clean tech. Their glass ceramic filters for vehicle emissions and industrial filtration systems are part of clean air regulation efforts globally. Supply chain control, vertical integration may help mitigate raw material and logistics costs. Risks and challenges. Cycle dependency. Demand for smartphones, TVs, displays are cyclical. If consumer electronics slow down, Corning feels it. Input costs. Glass requires energy, rare materials. Inflation and energy costs eat at margins. Competition and technological disruption. Alternative materials, cheaper display solutions, substitution risk exist. Macroeconomic threats. High interest rates, recession fears, slowing consumer spending. Also trade policy risks for materials imports. Valuation and analyst sentiment. Investors will want to look at Corning's P/E ratio versus peers, other glass display material companies, optical fiber firms. Is Corning overvalued based on growth expectations, or undervalued relative to its tech positioning? Dividend yield, if applicable, and free cash flow are also important. Does Corning generate strong cash flows to support its R&D and capital intensity? Analyst projections vary. Some see modest upside if display demand resurges. Others caution that good-on-paper potential may be tempered by real-world supply and cost constraints. Outlook and verdict. If you're bullish, this is a name to watch for display tech, telecom expansion, and AR/VR tailwinds. If you're conservative, the margin risks, macro sensitivity, and valuation uncertainty make this a wait-for-dip or clearer signals play. Final thought. Corning may be undervalued if its emerging tech segments hit inflection, but investors need to be clear about risks and not assume linear growth. Let me know in the comments. Is Corning a glass king that will shine, or a fragile stock under pressure? If you found this helpful, like, subscribe, and hit the bell so you don't miss future tech stock deep dives.